And how does a rental property via an LLC affect personal taxes? There was a lot of questions. There was about 5 to 7 questions this run around for, kind of in that same ballpark. So I thought we'd add it in there and maybe straighten that out for y'all.
And that makes a lot of sense.
It does.
The entity
Mhm.
or pass-through taxation tax filing deadline was last week, September 15th. It's passed, pass through. Was September 15th. And so people are starting to think about filing their personal tax returns. That is, if you filed an extension. If you didn't file an extension,
then we're way past, right?
All right. For more tax, for all your tax living needs, you can follow Toby Mathis. He's the founding partner here at Anderson Advisors on his YouTube channel. Smash that subscribe button, hit that like button, sign up for alerts. If you just want to watch these late at night when you can't sleep, that's what I do. Can't stop thinking about tax, right?
Can't stop learning.
Also, we have Clint Coons, our other founding partner. His channel is more geared towards asset protection, real estate investing. Both of them together have over 300 properties, real estate investors. They obviously run Anderson Business Advisors. So all of this is real world tested strategies, tax deductions, things like that. So give them a follow and a like.
Yes.
Want to talk about our tax and asset protection workshop?
Yeah, what do we got here? I think we have one coming up here, do we not? In fact, that's why they're not here. So we have one coming up in San Diego this weekend. I think it's what, the Thursday, Friday, Saturday?
Yeah, it's our live event. Every quarter we host a live event. All tax and asset protection partners are in town. A lot of our attorneys, our advisors, and you can come visit us. We've done it in Orlando and Dallas so far this year. This weekend we'll be out in San Diego. I think there's still tickets left, so head on over to our website if you want to join us. And then I think later this year we'll be in Vegas. We always try to do at least one in Vegas since we're mostly based in Vegas. But we also have our webinars, our day-long webinars.
We got that coming up on Saturday, October 5th, the 19th, and December 5th through the 7th. So there you can get in and just watch from home. Oh, I guess I'm sorry, the 5th through the 7th is live. That is our Vegas. There we go. 5th through the 7th is going to be live in Vegas.
Yeah, Elliot will be there. We'll make him come. Yeah. If enough of you email in or like, we need to see Elliot in person, live in Vegas.
Complete silence.
Complete silence. The Saturday webinars are really like a boot camp. It's 9 to about 4:30 p.m. First half's asset protection. Second half is tax. I teach advanced tax strategies. I'll actually be there October 5th and 19th. So you can't get enough of me. Sorry.
Good stuff.
Oh, sad for you. All right. First question. I just purchased a property through a self-directed IRA and LLC. I own a rental property. Will I be able to sell the rental property to my LLC?
Right. So what we got this property outside of our plan. We know there's a lot of cash in there. Why not just sell it to the plan, get some of that money out, and then we can take it out and do whatever we want with it? Well, we can't because it's called a prohibitive transaction. So no, that's a no. We can't. The quick answer is no. These transactions where you benefit as an individual from something done to or from with the plan, that's what's going to get us into trouble. And it's pretty broad and it's pretty deep what gets us into that. So anytime you're thinking that there's something that you might personally benefit from, you can pretty much count that it's going to be a prohibitive transaction.
Yeah, when I think about an IRA, I like to describe it as being sort of on a planet of its own. So your IRA, you're on Earth, you can do things on Earth. Your IRA is on Mars. We don't have the technology or the ability. IRS says, no, you can't go to Mars. So you're not doing any sort of business transaction with your IRA. And not just you, it also disqualifies your spouse, your lineal descendants, that's going to be your kids, and any companies that they own or run. None of those can do any business with your IRA or the property inside.
All those related parties.
All those related parties. And that's the reverse too. So if you own a property, you can't reverse sell it to your IRA. That's going to be a prohibited transaction. And what happens if your IRA participates in a prohibited transaction?
We can destroy it. And that basically means that all of it becomes taxable immediately. And you want to talk about doing some tax planning. That's where we have to really break out the big guns.
Yeah, we don't want to have to do that kind of planning. So it's considered essentially distributed to you on the first day of the year. So if you mess up and do a prohibited transaction on December 30th, it's treated as having been distributed to you January 1.
So you got to call us up.
Yeah.
Okay, we got to get to work on tax planning.
That being said, if you purchase a property within your IRA, so you're using IRA funds to purchase the property initially, and you want to then transfer it to an IRA owned LLC, well, then that is 100% allowable. And we actually do recommend that for asset protection purposes. So that means you have that limited liability protection so that if something happens on the property, that LLC is sued, you're not necessarily putting all of your IRA assets at risk. So that's all the other cash that could be in there, stocks, bonds, ETFs, those types of things.
Absolutely.
All right. Okay. Question number 2. How can I protect the capital gains from the sale of my primary residence after adjusting the cost basis and after taking the 121 exclusion and utilize that money for investment purposes?
So what we got going on here, if you sell your primary residence, first of all, we want to understand what a capital gain is. You bought at some point for a certain amount. Let's say you bought it for 200,000, and now 5-10 years later, it's worth $500,000. You want to sell. Well, your original basis was the 200,000, and there's some things that can impact that, but we won't go too deep into that. You'd subtract that from the $500,000 sales price, you have 300,000 a gain. But in step this 121, 121 is an exclusion just for our primary residence. And it says if it's your personal residence that you've owned and used as a personal residence for 2 of the last 5 years, well, you might be able to take some money off. Okay. And usually it's 250,000 if you're single, 500,000 married, filing joint. So in this case, we're going to take that original basis, 500,000. If we're single, then we'd be 250,000. That's 450,000 that we have that we don't have to pay tax on in that example. Subtract it from the 500,000, you'd only have 50,000 of taxable gain at that point. Outside of doing a 121, there's really nothing we can do against that pile of money related to the sale of the house, other than sometimes we can use another entity, yes?
Yes.
And what is that entity? Any idea?
So we teach a strategy, and I go over this in detail in our Saturday webinar, but you can, if you have your primary residence and you want to keep it perhaps as a rental, and you just turn it into a rental, well, then you're looking at a depreciation deduction based on that original basis, that 250. And so that's a smaller deduction that you get to take for the business use of your home. So instead, we're losing out on that 121 exclusion, that gain, excluding that gain. And also we have a pretty low cost basis if we've owned the property for a long time. So what you can do, if you don't want to necessarily sell, you want to keep it as a rental, you can sell it to your own S corporation, and you can sell it for fair market value. So you do need a little bit of cash, at least 10% down, to put into the S corp so that it can purchase your primary residence from you. Again, this is a fair market value, legitimate sale transaction. What you're going to do is you're going to set it up as an installment sale. An installment sale, also known as seller financing, means that you as the property owner have sold the property to your S corp. The S corp's going to pay a reasonable interest rate and make loan payments to you over the course of 5, 10, 30 years, however long you want to set that loan for. You're seller financing it. And then when you go to report on your tax return, you're going to recognize all of the gain from the sale in year 1. So then you'll be able to stack that 121 exclusion right on top of it. Take that exclusion of 250,000 or 500,000, depending on if you're married or single or married filing jointly. And then, but moving forward, you're actually only getting paid in monthly increments. So you're only then going to be paying tax on that small amount of interest that you receive each month. And so that's a great way to not only take advantage of the 121 exclusion, but keep the property and continue to rent it out while resetting your depreciable basis on it.
And that depreciable basis being higher, as Amanda pointed out, definitely helps us reduce the cost for or assuming against the income coming in from the rental aspect. But remember, we can't, because it's a related party. Again, you're selling to your own S corporation. We can't do bonus. You hear us talk often about bonus depreciation. So just a little reminder there. Again,
We're still taking just straight line.
Yes, we're still doing straight line. And as Amanda also pointed out, she pointed out a lot, but there was you have to recognize all the gain, if any, that particular year. Exactly right.
There are usually some questions that come from the 121 exclusion. So you say 2 out of 5 years.
Yes.
Does that need to be the most recent 2 years?
That's a great question. It just says two of the last 5 years. It doesn't specify. In fact, when you look at some of the calculations, sometimes they go by month, sometimes they go by number of days. So basically within a 360-day period or 365, whichever the code is using, they do use both of them sometimes. As long as you meet 2 years within the last 5 years, non-consecutive or consecutive, we've ticked that box.
Yeah, so if you lived in your primary residence, you've moved out maybe, if you're thinking, oh, if I move back in to meet that 24-month marker, then you can implement this strategy as well. Even if you're not doing the whole S Corp sale and keeping it as a rental, you could still take advantage of that 121 exclusion.
We used to see that a lot with deployed military. They make, they leave the house, they're overseas or whatnot, and they come back. As long as they're still within that 5-year window when they do everything, they move back in, they could take advantage. There are, just so you know, other unique situations when you have to move because of work like that come into the 121. We're not going to go into those today, but just be aware, if you run into things and something made you move for work related, you might still be able to do some things there.
Yeah. All right. Can I use 1031 exchange when flipping properties under 1 year of ownership? So let's define what's a 1031 exchange.
Right.
Let's start there.
Yeah, definitions definitely here. 1031 exchange, you have an asset that's used in a trader business. That means on a regular course through running the trader business. You got a washing machine, whatever it is. You can exchange it for like-kind material. Now, it used to be before the 2017 Tax Cut and Jobs Act, I could exchange cars, had clients do that with trucks and things like that in the business. But now, after the Tax Cut and Jobs Act, we can only do it with real estate. So we got to have a rental or something like that we use in a trader business.
Held for investment purposes.
Absolutely. And we exchange that. That's the relinquished property. And then we pick up a new property that we're still going to use in a trader business. And that's the replacement property. The idea is that if we do this properly and the numbers check out all right, then we can defer any of our taxes. We don't have to pay any taxes. Defer them. That doesn't mean we don't necessarily have to pay them later on. We just don't have to pay them now, okay? And it's possible to defer them for the rest of your life. I pass away, I leave it to somebody, they will get stepped up basis and never have to pay tax on it. And that way it was basically deferred.
All you got to do is die.
Yeah, just got to die. That's
easy
You
peasy.
can't beat that.
All right, so how does that differ from flipping properties? Because when you're flipping, you're not holding the property for investment.
But you're using it in a trader business. And that's why we get asked this a lot. Because you're flipping, that is a trader business, and we're going to use that in a trader business in the future questions we have coming up here. But the IRS looks at it differently. Yes, it's real estate. Yes, you're flipping in the sense that it's used in a trader business because it's part of your flipping business. But the IRS looks at it as inventory. And that's the big difference that Amanda's pointing out. It's no different than we go down to Target or Walmart and pick something off the shelf. It's just inventory. We're not allowed to do that, a 1031 with that. It's got to be something that was used in the everyday running of that trader business or investment, and that's certainly not inventory. So we got kind of a mix up here, and this is why I like to pick these type of questions because they really are starting to kind of go off center. We have a 1031. We know that's for exchanging things that are used in a trader business, real estate. Flipping something different where we picked up a property, we fixed it up, and then we sell it right away like inventory. We can't use the 1031 with that. Those are two different things. The 1 year of ownership, why do you think that's coming about? Is that
a lot of times people have the misconception that if you purchase a property for a flip and then you decide to keep it and you hold it for at least a year, some say if you purchase it in 1 year, hold it at least to the next year, that you can sell it under a 1031 exchange and get the tax benefits. But
no,
you can't.
The IRS is going to look at that typically, and they're going to say, look, you can't change that intent. You held on to it. It was always with that business. So it's very, very difficult to try and prove that you ever changed the intent. In fact, Toby and Scott Estell work with Toby on the tax toolbox. They have a video, one of the early videos where they go over exactly this point. And there's a famous case that I can't remember the name.
So famous, we don't even remember it.
That's what we have Toby for. He remembers all those. But this went on for over a decade. They had bought a property that they intended to, sell off the little pieces, flip it, what have you. But over 10 years, they didn't sell it. And the IRS still came back a decade later, a decade plus, and said, no. That's ordinary income, essentially flipping. Doesn't matter that you had it over a year. But why do we talk about the 1 year? One thing is because 1 year is associated or greater associated with what we call long-term capital gains tax, which means if this was a capital, we held it over a year. And if we could sell it as a capital asset, we'd only have to pay 20%, maybe 15, maybe zero, depending on our tax brackets. But because it's considered ordinary income, it's going to be at our ordinary bracket rates, maybe 37%, something like that, 32, what have you. So we got a lot of confusion going on here. The 1031 is for something in a trade or business. Flipping is completely unrelated. And if we're thinking flipping, that means we're never going to run into this 1 year of ownership. That's irrelevant.
I mean, even if you're a bad flipper,
Even if you're a
and
bad
you end
flipper.
up holding it for more than a year, it's really your intent when you purchase the property. And you may think, well, I can just go into it and not decide, not knowing what I want to do. But as real estate investors, there's a lot of factors that go into purchasing a property. And for the most part, they're going to lean on what the actions you then take in terms of all of that. So if you're a flipper and you only flip properties, it's going to be really hard to convince the IRS that in just this one occasion you didn't intend to flip.
But just real quick to expand on what where Amanda was going there. What if you do have a house and you're not sure what you want to do with it? You don't know if you want to flip. And I have been there. That I actually have done. Lost everything on that investment, but nonetheless, real estate still, I back it all the way. It's a great investment. But I didn't know. I didn't know if I wanted to flip it, didn't know if I wanted to rental, but I'm not going to put it into C Corp unless I know that I know that I know that I'm going to flip. Then I'm going to put it in my corporation, flip it underneath there, and then I'm okay because I know that I used it for flipping purposes. Easy to put things into a corporation, as we always say, not so easy to get them back out, okay? So wait till you know what you want to do with that thing. If you're going to flip it or keep it as a rental, that's what I'm getting at, then decide which pathway to take.
Alrighty. Okay, another S Corp. When taxed as an S Corp and on payroll, how do you determine the right pay for yourself? Is it worth all the taxes you pay into Medicare and Social Security? And so far, we've paid $30,000 in payroll taxes. Will that go towards our tax bill at the end of the year? So let's attack this piece by piece. You have an S Corp. You do have a reasonable salary requirement, and that reasonable salary is 30%, 33% to 60% of the net income. So you're looking at all the income that comes into the S Corp, you're taking all of the normal business expenses as deductions, and then you have to pay yourself at least 1/3 up to 60% of what's left. We have a lot of clients who, if you don't necessarily know how much your S Corp's going to make at the end of the year, there's no requirement that you're paid every 2 weeks or every month. That's more just normal business practices because when you're paying employees, they want to be paid more frequently. If it's just you being paid payroll, you can do those calculations at the end of the year and just pay yourself one lump sum. That's sometimes easier to implement some of the strategies that we implement for S Corp. So first of all, you do have to pay yourself a reasonable salary. It does not matter if you think you'll be in Medicare or using your Social Security, or if you think it's going to be worth the payroll taxes are quote unquote worth it. If your company is making money, you do have to pay a reasonable salary. Elliot?
Yeah, and along the thoughts of reasonable salary, we do throw that out a lot, 25, 30%, up to 50, 60%. And you're going to hear a lot of CPAs talk about that, a lot of tax professionals. Just so you know, that's just usually what we say to give a guideline. The rules, that is not part of the code, okay? There isn't anything about 30% or 60%. Really, it's what would a reasonable person make doing what you do in the area you do with the profitability, the experience that you have. So that's the real test that they're going to use. But typically what we're going to say is anywhere from 25, 30% up to 50 or 60%. That's often what we all throw out there.
But there are ways to reduce what the reasonable salary would be. If you feel like you're paying too much in payroll taxes, well, then let's first take things out of your S corporation using tax-free reimbursements. And this is going to work best if you don't have any other outside employees. Any sort of reimbursement plan, retirement plan does need to apply to everyone in your company who qualifies. So if you're the only people on payroll, only full-time employees, then We want to max out that accountable plan. We want the company to reimburse you for administrative office in your home. That's going to be a percentage of all of your utilities, your mortgage interest, your rent, sometimes your landscaping and your cleaning if you have clients in your home. We also want them to reimburse you for mileage, for use of your cell phone, for internet. All of these are under tax-free reimbursements under an accountable plan. So they're deductions for the company. And then you get reimbursed, and that reimbursement's not included in your taxable income. So by bouncing those expenses through your company, it's tax-free money in your pocket. Another one is 280A. Elliot, what's 280A?
280A, simply having those corporate meetings. I'm sure you've heard about that before. We talk about it an awful lot. The idea is that you can rent out your house to anybody for you, whoever you want, for 14 days, no more, and the income that you receive is tax-free. Best plan, why don't you go ahead and rent it to your corporation, or in this case, your S corporation. It conducts a meeting in your house, maybe once a month, double up in a couple of the months, meet that 14. That money comes to you tax-free and deduction at the same time. Two birds, one stone.
Two birds, one stone. And you just charge your company a reasonable rate. So you go out, get a quote from a local work office space, conference center, hotel. We're based out here in Vegas. We're going to go to that most expensive hotel. Any quote that you can get out there on the open market is going to be a reasonable quote. So I have a client in Brooklyn who has a tiny, tiny apartment in Brooklyn, but was able to get a quote from a little hotel around the corner for $3,000 a day. So he's able to do this times 14, and that's, again, tax-free money to you. So that's reducing the net income to your company, which is then reducing what the reasonable salary that you have to pay yourself is. Second, a salary is not always bad. We can defer some of that by setting up a 401k. Again, that's going to work best if you are the only owners and employees in your company. If you have a 401k, you do have to offer it to all the other full-time employees. You can't just keep it for yourself, or you can't set up another company with a 401k, shift money over there. So you only have to give it to yourself. So this is going to work best if you're the only owners and employees, and your company, not only can you defer up to $23,000 from the salary you're paid, add an additional $7,500 if you're 50 years or older for catch-up contributions, but your company can then match that up to 25%.
Exactly right. So all of that, giving deductions against this income, lowering amounts that we're going to have to pay tax on in the end. Lots of different things we can do here. And if we make enough, we can maybe even put into a defined benefit plan where you really get to roll the dice and put heavy amounts in, several $100,000 or more. So a lot of opportunity here with what's going on in the S corporation. And I know 30,000, we kind of talked a little bit about this before we started here, that 30,000. Remember, some of that may not all be just Medicare and Social Security. Payroll could include some of the federal taxes and state income taxes. So that 30,000 amount, might not all just be related to the employment taxes.
Yeah, maybe it's just the withholding amount, in which case you don't necessarily want to reduce your withholding unless you want to pay a huge tax bill at the end of the year.
Correct.
That withholding's just taking it out
Very good.
as we earn it, so we don't owe a lot later.
Yep.
Alrighty. What is the minimum you must do to maintain your real estate professional status and not be considered a dealer if you do intend to flip a house? Another flipping question. Okay, so let's define what a dealer is, and let's define what a real estate professional is.
Yeah, you can't go 2 weeks in Tax Tuesday without running some, questions about real estate professional status. We run into it all the time.
Sure.
But let's hit dealer first, because we hear that, but probably not as much.
Yeah, because we're in Vegas, so
right? Exactly.
there's dealers everywhere.
Yeah.
That's not what we mean.
So the dealer here, what they're referring to is, if you do flip a lot. Remember, we talked about the flipping earlier. It's not the sell of something that's used in your trade or business. It's selling inventory over and over. We have a quick buy, then we sell it down the road right away, hopefully at a profit. We know we want to do that in a corporation, but what if we didn't? What if we did it in our personal name? If you start repetitively doing that over and over and over, the IRS is going to look at that, well, maybe that's just what you do. That's your business. And then all of a sudden you pick up one property and you say, no, I'm going to hold this as a rental, let's say. You're still flipping on the side, doing, a couple flips here and there, but you have this one property. Then all of a sudden something goes wrong. You hired, or you let Elliot in as a tenant and you want to unload that thing. You want to sell it right away. IRS is going to look at that as a flip because they think you're a dealer, that's all you do is flipping. And now, even though you had this legitimate, your intent was to have a long-term hold, but you sold it right away, they're going to consider that a flip too. And they're going to hit you with ordinary income tax rates, which are much higher. And it's subject to employment taxes, which we just addressed in the previous question. Instead of that capital gains that we're talking about if we'd held it over a year or something like that. So a lot of unfavorable treatment. You can't use installment. You can take installment payments, but you got to recognize all that gain right away the first year. Amanda alluded to that in one of the other questions, kind of unrelated, but same principle.
No
That's
1031.
no 1031, exactly. No 1031 allowed with the flipping, none of that going on here. That's our dealer status. But then we go to rep status, real estate professional.
So real estate professional is you have to meet 2 tests. And so it's when you spend 50% of your personal services time and at least 750 hours in your real estate trader business. So if you have a full-time job and you work 40 hours a week, you need to work at least 41 hours a week on your real estate. A lot of times you can't meet this if you have a full-time job. The places I've seen people doing it are people who work part-time, maybe teachers who work seasonally, or if you have a spouse. If you have a spouse that works out inside the home, that's not considered work by the IRS because they don't know what they're talking about. That's a lot of work. That's 24/7 work, but it's not recognized by the IRS. So your spouse can actually meet real estate professional status. And then you need to materially participate. And so that's either 100 up to 500 hours of material participation on that activity. Most of the time, people are looking at rep status as a way to offset or create losses against their active income. So active income is going to be something like flipping because you're a dealer, your W-2, your 1099. But the key to rep status is that you actually have to generate losses on that, what would normally be passive activity. If you're not generating losses, then it doesn't really matter if you hit rep status because there's no benefit to it. We've taken our passive rental activity, it's now active activity, but you're just going to, if there's no loss, you're not reducing the amount that you're making, whether it's through flipping or through W-2.
Exactly right. But assuming that we are trying to get the real estate status, like you said, over 50% of our work week in a real estate trader business that we materially participate in, over 750 hours. But then you have to also be managing your rental properties directly yourself, or you can aggregate and you just have to materially participate in the overall management of all of your rentals. So in this case, again, we just want to separate real estate professional status. That's going to have to do with long-term rentals. Flipping, dealer, all of that going on is a whole different separate job, if you will, or occupation. But we'd want to do that in a corporation. Now we can do both. If we do it in a C or S corporation, that is the flipping, we avoid dealer status, okay? And then we can still use those hours towards getting our 750 hours on the rep status. So you can do both. You just want to do it in the right entities.
Type of entity.
Yes.
Entities are important, not just for your asset protection, but for your tax strategies.
Exactly.
All right. What happens with the capital gain from stocks or from the sale of a rental property when inside of an S corp? Is it ordinary income, Elliot?
It is
the
income.
Short answer is
no.
Yes, no.
It is income, yes. Ordinary, no. When we deal with a pass-through entity, that's your S corporation or your partnership, we have what you could call the operational expenses and income for whatever business it's in. And then we have what's called separately stated items. That's a fancy IRS term for things like portfolio income, interest, capital gains, dividends, things like that. That is considered outside the business and immediately takes a fast path to your 1040, okay? And we kind of treat those separately. So this brings up a lot of different issues here. Oops.
Wow.
Turn,
put your phones on silent,
yes.
people.
The separately stated items, that's going to be your capital gains, et cetera, things like that. And it is not considered ordinary income. Whereas if we were flipping, let's use that as an example on our S corporation, that's going to be the ordinary income from the flip. Like we talked about, it's not capital gains or anything like that. So that's what we would use to distinguish between the two types of income, that type of activity.
So I was just at a real estate investing or an investing conference for dentists. And a lot of them own their practice in an S corp,
Mhm.
but then also own the building. So if they did it the wrong way and put their building inside the S corp, then that's what we're talking about, right?
Yep.
The income and the expense from running a dental practice, the fees that patients pay, the insurance that comes in, minus the cost of an x-ray machine or those little scrapey tools. Those are the normal income, the ordinary income on the S corp.
Yes.
But the building would be that separately stated investment.
If we sold it, yes, the capital gain is going to be a separately stated item. Now, the operation of the building, if you're renting, if it's paying rent or something like that through, I don't want to get,
Like other people are
right.
renting space in the building as well.
Exactly. That very well might show up on the front. They may consider that being separately stated items as well. There's just other, but to the point, the running the operational business, that's going to be on the front. We call it the 1120S. That's the S corporation return, as opposed to any capital gains, dividends, things like that, which are the separately stated, and they are not ordinary income. They are treated, even if it's portfolio income interest, things like that, it might be taxed at ordinary rates, but we don't consider it ordinary income. And I guess we really should have brought that up.
Rude.
Right?
Why are
Exactly.
you calling it the same thing if it's basically the same thing?
Exactly. We got ordinary income, operational in the case of the dental practice, portfolio income, which is kind of more your investment interest, things like that, capital gains, and then then we have a whole nother bracket between passive and non-passive, which is another. So there's all these different types of income in the code. In this case, it's not ordinary income.
Not ordinary income. There you go. All right. What is a list of deductions with a STR? That's a short-term rental for those of you in the know in the REI. As passive income when material participation is not met, compared to a list of deductions when material participation is met.
All right. So
this is a confusing question.
Yep.
For the answer to just be nothing.
Right.
There is no difference.
There is absolutely no difference. And if we take it back for a second and analyze why, well, if you have a short-term rental and you're not materially participating, you don't do a whole lot. You're an Elliot. You sit on the couch and don't do much.
You're an Elliot.
Right? And you have someone, except for her daughter, Elliot.
I'm going to say that to my husband when he's sitting on the couch watching sports. Don't be an Elliot.
Well, except for, you may not know Amanda's daughter is named Elliot too. So, and she's a hard worker. Okay. So fantastic young lady. But if you're this Elliot, you're not doing a whole lot. You're very passive. Okay. I pay someone else to do everything. I pay Eric. He's out there working and all that. Okay. Anyway, but it's still a business. And if it's a business, it's going to have business income, business expenses. Now let's switch it, and we have someone more responsible than Elliot who is materially participating and overseeing the whole show. They still have a business income, business deductions. Those deductions, that's all the same. There isn't any difference between the deductions if you're passive versus the deductions if you're materially participating and it's non-passive. Now the impact of everything might be different, but you can still do a cost seg, bonus depreciation, et cetera, on a passive investment. There's no prohibition to that. In fact, sometimes we do that for some tax savings, but it's not going to offset against W-2 income, perhaps. It might go against other passive income, but it's the same list of deductions that, for a passive business as it is for a non-passive.
That's right. How much you work in that business or participate doesn't change that. If you have a regular company and you're buying office paper, you can deduct that whether you still work there or if you've retired and you're just receiving dividends. So when we talk about a list, is there an actual list?
There are two suggestions I would go. If you just Google IRS PDF Schedule E as an echo, that's going to show you all the lists.
As an Elliot.
Yes, as an Elliot. That will show you all the deductions you could take if it's considered maybe passive, it's a short-term rental, or a long, what we have for long-term rental. But the idea is all those are business-related expenses that you can deduct, or IRS, Google IRS, PDF, Schedule C. That's where you might have a short-term rental that's non-passive. We put it on there. It's going to have all these business expenses. Either one, look at them both, pull them up, copy them off, save them.
Yeah. And that's just a starting point. Any business expense that's corn, so common, ordinary, reasonable, and necessary to the functioning of that business is going to be deductible. So for rental property specifically, we're looking at utilities, property taxes, furnishings, the expense for a property manager, for legal or accounting fees. All of those things are going to be deductible, whether you materially participate or not. Now, if you are materially participating, maybe you're deducting home office expenses. And if you're not materially participating, well, then maybe you don't have a home office to deduct. But sort of just depends. It's all going to be the same expenses that are deductible against the activity.
Exactly right. So kind of a trick question.
Schedule E for Elliot.
Yep.
All right, we're going to take a quick break to promote our tax and asset protection workshop. We have day-long Saturday seminars coming up, October 5th and October 19th. That is the Tax and AP Boot Camp, as we call it. Some people have described it as drinking from a fire hose.
Yes.
We have speakers on who are experts in their field. I say that knowing that I am going to be presenting the tax sections on both October 5th and 19th. But then we also have in the background CPAs and attorneys that are answering questions. So you can come, learn a little, but then also ask questions and get your questions answered. And then we have our live 3-day workshops. The next one is actually this weekend in San Diego. There are still tickets left if you want to head over to our website. And then this December 5th through 7th in the wonderful Las Vegas. We're based out of Las Vegas, so we like to have everyone come see us.
Yep, fabulous Las Vegas.
Bring your self-restraint to that one.
Right.
Some people forget that at home when
Right.
they come to the Vegas workshops. But go to andersonadvisors.com, I think /events, and you can get tickets for any of those. The Saturday seminars are free, so come often. All right. If I volunteer my work or time at a nonprofit, is this tax deductible?
Well, no. The time is
Your
not.
time is worth nothing.
Right, exactly. It's not, at least to the code, it's not. So the quick answer here, we do get, this gets asked a lot.
Mhm.
You know, what if
Well,
I,
especially people who charge by the hour. Like as a
Right.
baby attorney, I was out there charging $600 an hour. If I went and did 10 hours of pro bono work, should I get compensated?
something? Of
Something
course she should.
for
you know?
the $6,000 that I didn't earn working for a paid client. And unfortunately, no. It
Yeah.
was just the good feelings I got.
Right.
Yeah.
Waking up at 5 in the morning to get there to wherever it is for the nonprofit. But yes, but what you can deduct, there are some things you can, the mileage. Okay, that's something. And it's got a great rate of what?
14 cents a mile.
Okay, so it's not even the 67 cents a mile that we see in an ordinary business mileage, but 14 cents, hey, that's something. So there are little things like that, but
you do need to be itemizing your deductions
Right,
though in order
that's
to
another
make that
catch.
expense. So if you are not taking the standard deduction, remember the standard deduction bumped up with the Tax Cuts and Jobs Act in 2018. So a lot fewer people are itemizing because the standard deduction is so high. But if you are one of those that itemize, that's going to be on your Schedule A, you're going to be able to deduct things like state and local taxes, medical expenses, charitable contributions, so actual money or property that you've donated to a charity, and then that's where you'll take that 14 cents per mile. So you do need to document it. You need to keep a mileage log, or you can do actual expenses. So that's going to be the fuel, etc. That's a little harder if you're not doing a ton of work with the charity. I always for businesses, I always lean towards the mileage log because it's just easier. There's a lot of apps you can use where it'll track that for you there. So we can take the mileage and then anything else?
Well, not as far as our time. That's certainly no. I mean, they're like we said, the donations themselves.
Yeah. So if
there's really not a lot more.
Yeah, so I volunteered at like a soup kitchen. And so if I'm going and they're like, hey, can you pick up some serving trays and some serving
Certainly
utensils on your way? Then I leave those there. Then yes, keep track of that receipt. You can deduct that again if you are itemizing your deductions. But if you buy it and you take it and you're like, oh, they don't really need this, and you take it home with you because you're like, oh, I brought it, I'm just going to take it home. Well, then obviously you didn't give that to the charity, so you can't deduct that.
Right.
So things that you're paying, that's really no different than dropping off a garbage bag of stuff at Goodwill, though, really.
Correct.
Yeah. Your time is worth nothing.
Nothing, nothing to the code.
Sorry. All right. I have W-2 and 1099 income. Again, a side hustler. We love to see it. And they bought a house to flip. Woo!
Busy.
How can I best take advantage of this financially to save on tax?
How do we? Well, first thing, just that 1099 income, I'd want to know what that's coming from. Maybe we can do something with that, put it through a C corporation or an S corporation. But
That's
now,
really way better than my answer, which was sell the house for a loss.
you could do
You'll
that
pay
too.
less taxes if you flip the house and don't make any money. I'm just kidding.
Always a great deduction there.
Yeah, let's first talk about taking that 1099 income. And if you're making maybe 25, 30,000, let's throw it into an S corp.
Yeah, typically go S corporation. Maybe we have some medical expenses and things like that. So we might want to think of C corporation, either one. We just look at the situation, but that'd be the first thing. I'd want to look at that 1099 income because there's a lot of different types of there's over a dozen types of 1099 forms and types of income. So we'd want to probably focus on that first because that might have more savings than everything else that we would see in this answer. But then we bought the house to flip. And that, as we talked about earlier, we don't want to do it in our name, just number one, for liability purposes. All the great tax planning in the world doesn't do you a hoot of good if you get sued, okay, and you don't have asset protection. So we can save you all day long on taxes, but if you don't have that asset protection, it's not going to mean anything.
It's just more money to pay the lawsuit with.
Right, exactly. So there's a bright side to it. You want to talk about your loss, this is going to get you your loss. If you
sell for a loss or get sued. This is the place you come for like the really great tax advice.
Exactly. This is not the Toby show today. But if we flip that house, let's do it in a corporation again, S or C corporation, take advantage of all those reimbursements Amanda went over.
Accountable plan,
280A,
medical reimbursement plan if you're in a C corp.
make enough, pay yourself a little wage, maybe put into retirement plans.
Yep.
All kinds of good stuff. It just doesn't stop. All right, there. So how can we best take advantage of this? Well, that's the first thing, how we're going to structure all this income coming in and taking advantage of everything we can do there, number one. Now, let's say we have leftover cash afterwards from all of this. Well, then how we use that, if maybe you use it to buy another short-term rental or something like that, and you could get a write-off that way. Maybe you have other rental properties in your real estate profession. We talked about that. There might be a play there to take some cost seg bonus depreciation, maybe create a loss there right off against all this income. So how you use it after we've done everything tax-wise that we can immediately to reduce taxable income, that extra cash, maybe you can do something with that or invest into your nonprofit, set up your own nonprofit. Just don't count on the mileage, okay? As we saw earlier, all right?
Charitable contribution deductions.
That's going to be better than the mileage.
30% of your AGI or 60%.
Right, 60% cash, and if that's what we're talking, we have cash here. Oil and gas investments, things like that. So there's lots of tax planning opportunities here. But again, it all starts with that structuring. We want to get the right entities taking in that income, get all that handled first, mandate it out on the S corporation, get those reimbursements, admin office, 280A, if it's a C corp medical, things like that, pay into retirement accounts, et cetera, hit all these things first. And then let's see what we have left over and see if some of these other things might work.
Yeah. These questions are great because a lot of times you have an idea, but then that actually just opens the opportunity. So it's not necessarily that you have this W-2 and 1099 income and that the house flipping is going to directly offset that in some way. It's that we're looking more deeply into what's already happening, what tax strategies are we already not taking advantage of that we can sort of get into. And then again, once we have that cash from the flip, is there something we can then turn around and invest in to generate some tax strategies and some deductions there?
Yes. Great question.
Not always a super obvious answer.
No.
All right. Our final question. How does rental property via an LLC affect personal taxes?
We had almost maybe 10 questions related to this question, for this last 2 weeks. So I definitely wanted to throw on there. I've never seen a question asked so much, probably as much as this was in the last 2 weeks. What's the idea? Well, strictly speaking, nothing. Okay, you put that rental property the way we set it up, it's going to be in what we call a disregard LLC, which means it doesn't have a tax return. It may go through a partnership. Yeah, that has a tax return, but that is what we learned earlier is a flow through, pass through entity. So it's just going to hit your 1040. None of that has any impact whatsoever on your personal taxes.
A lot of people are really surprised once we set up an asset protection structure because it can initially look intimidating or complicated. There's a holding company, there's individual LLCs for each property. Maybe there's a land trust that we've put in there to avoid transfer taxes or the due on sale clause. So it can be 3 levels or more, that can be intimidating or complicated. A lot of CPAs, you'll go to your CPA and they'll say, what did you get all of these LLCs for? Why did you make it unnecessarily complicated? And it's because they don't understand the legal, they don't understand the asset protection side. But then a lot of people are surprised, like I said, that in reporting their taxes, absolutely nothing changes. Your entire asset protection structure can be completely disregarded for tax purposes. And where you reported that rental before the LLC, you're reporting it right there, Schedule E, page 1, after the LLC. Like Elliot said, the only time that changes is if you have a partnership holding company, and that's going to be mostly for spouses. If you own the property together, we're putting it into a holding company. If you're not in a community property state, 2 owners, automatically a partnership. It's going to require that 1065 filing. Then that goes K1, reported on your Schedule E. Page 2, it actually makes your personal 1040 a lot simpler.
Yes.
A lot of those income and expenses that would normally show up on the Schedule E, page 1 for each individual property are now just reflected on your 1040 through a single K1 line item. If you are in a community property state, and there's like 9 of them, California, Nevada, 7 others, I guess.
Arizona, Texas.
That I haven't lived in, so I don't know what they are off the top of my head. But if you are in a community property state and you own that holding company with your spouse, you file a form and you can elect to be treated as disregarded. So in that case, your reporting doesn't change at all. And again, even your bookkeeping doesn't necessarily have to change. You don't have to have separate books for each LLC. The IRS rule is that they're separable, not that they're actually separate. Now, is it easier if you have a separate set of books for each LLC? Yes, at tax reporting time, that is going to be easier for your tax preparer. That's what we recommend for our clients who do their taxes. 1 set of books for each tax return. That's actually what it is. We've got Troy, who is our bookkeeper extraordinaire, and he would... I got to make sure I say it right for him. So 1 set of books for each tax return, and then you're still going in and attributing every single dollar to the property. So it's not that you have an LLC, it's that you have multiple properties, income, rent from one property. You can't treat it as mixed in with something else. So your bookkeeping, your tax reporting, for the most part, is going to be exactly the same.
Absolutely.
Anything else
No,
on that one?
that was it's a great question. Got asked a lot, and like Amanda said, it's easy to get kind of confused with everything going on in the structure, but the truth is it doesn't have any impact on your taxes.
Yeah. Would you prefer, if you had the option, to do a partnership holding versus a disregarded holding? What are the pros and cons of that?
Yeah, well, let's look at the cons first. You have an extra tax return, okay? And that, one can understand that it's an extra cost. But as Amanda pointed out, the bookkeeping is really going to be essentially the same because you have to keep track of it anyway. However, the upside, number 1, it reports differently on your return. It goes to Schedule E, page 2, as opposed to Schedule E, page 1. And you can get a lot more lendability. The lenders are allowed to lend more to a partnership than they are to you as an individual. And if we're in real estate, which is probably why we're doing all of this, that's probably going to be a part of someone's conversation in their investing somewhere about getting more lendability. And so, yeah, I'm going to like the partnership myself.
I do too. Partnerships, S Corp, C Corps, are the audit rate for those are a fraction of what the 1040 audit rate is. So would you rather see every dollar and cent that comes in and out regarding your rental properties right there in your 1040, or are we moving all of that to a partnership, and then only what's showing up on your 1040 is just that single line item? So if you do have the opportunity to do a partnership, we do like to do those instead of a fully disregarded entity. But again, not always going to be the case.
Yes.
Alrighty. One last plug for the man, Toby Mathis. This is his YouTube channel. Tons and tons of information. He also has he's got a TikTok. He's a tax-wise Toby on the TikTok. It's like he's a Gen Z. He's basically Gen Z, guys. Not at all, not at all. So like and subscribe there. You can set it so you get notifications every time something new comes out. They are very popular channels. And Clint Coons, he focuses more on asset protection. So I actually know somebody named Clint Mathis. Isn't that funny?
Oh, wow.
Professional soccer player. So
there you go.
every once in a while,
Yeah.
Just mix them up. Fun fact, Clint has a cat named Toby.
Yes, I think so.
Toby have a cat named Clint?
Oh no, Toby has a cat named Clint. I don't know if Clint has one named Toby. He might.
We got to get him one. If he
Yeah,
doesn't,
right?
we got to get him one.
I'm
All
sure
right.
he'll be happy.
So like and subscribe to both of those channels. We're also, Anderson Advisors is also on Instagram. We're on Facebook. We're on the TikTok. And one final plug for our tax and asset protection workshop, October 5th, October 19th, our day-long seminars, the boot camp of tax and AP, if you will. We've got great speakers. Again,
Yes.
it's going to be me. And then September 26th through 28th, that's this weekend, we'll be down in the lovely San Diego. December 5th through 7th, we'll be in Las Vegas. Tickets for both of those events are still available. If you're already an Anderson client, just go ahead and shoot a note to your team and we can get you the links for that. Finally, if you want your question to be featured on Tax Tuesday, please email us in taxtuesday@andersonadvisors.com. If you can all get together and ask the same question, Elliot really, really likes that. It makes it easier to choose.
Easy voting,
Easier to
right?
choose. It's funny because it tends to go with the season. So
It does.
how do I report my taxes? Not surprisingly, in September when a lot of people are reporting their business and personal taxes on extension. So we get similar questions around
We do.
April and March as well. So bring us your question. Nothing is too complicated. We leave
We've
those
had
for
some. Okay,
Toby mostly, though. We leave those for Toby mostly.
Yep.
Tax Tuesdays on live on YouTube. And if you want to head over to our Toby's YouTube channels, there's a whole playlist of former Tax Tuesday questions and replays and all of that. They're fun to watch. For all of us tax nerds here, to all of you tax nerds out there, thank you so much for joining us. We'll see you next time.